So we always start with net income at the top of the cash flow statement. And this obviously comes from the income statement. And then we get one more item, usually from the income statement, which is depreciation and amortization. You just add it back because, of course, it's not a cash expense. And after depreciation, what we do is we look at the change in working capital. And working capital means current assets and current liabilities. Okay, so you look at the current assets and current liabilities and note the change and add those here. Okay, so accounts receivable went up $170,000, which means it's cash kind of out of our pocket. And remember, inventory was an absolute disaster last exercise when we were looking at the balance sheet. And so we're going to deduct it here. And we owe $15,000 more than we did in the previous time period when it comes to accounts payable. So that's a net cash temporary benefit, okay, for us. So we put that in your pocket. And that gets to cash flow from operations of this amount, okay? Nothing to do here because there are no changes for these items on the balance sheet. And then lastly, cash flow from financing. We actually increased our debt a bit for short and long term, as well as common shares. And so add all that stuff together, this guy, and this guy, and that gets you negative $298,500. And I wrote here, please note the change in cash flow has to equal the balance sheet from the current year minus the balance sheet from the last year's cash position, okay? So our cash position decreased by this much. And the beautiful thing about the cash flow statement is that you actually only need the income statement and the balance sheet to make it. So it's really easy. And when we do the financial modeling section very soon, you'll see that we don't really have to look at the cash flow statement or really spend much time at all preparing it because it's automatically prepared for us once we create the income statement and the balance sheet. It's automatically prepared because it's all just calculations that are linked between the income statement and the balance sheet. This will make much more sense to you in a couple of sections. Thanks.